Today, we are going to pull back the curtain on the world of budgeting. You might think this is just a dry exercise in data entry, but as we'll see, it is actually a high-stakes combination of strategic roadmap and behavioral science. Let's dive into the nature, objectives, and psychology of budgeting. A budget is more than just a spreadsheet of doom. It is a formal, written statement of management's plans for a specific future period, expressed entirely in financial terms. Think of it as the definitive roadmap for your fiscal year. It takes those big, qualitative strategic goals, like becoming a market leader, and transforms them into quantitative, measurable operational targets. To be successful, organizational budgeting rests on 3 load-bearing pillars. Pillar 1 is planning, setting specific goals and making proactive decisions. Pillar 2 is directing, the execution phase where we implement the plan through responsibility centers. And Pillar 3 is controlling, the evaluation phase where we compare actual results to our goals to identify variances and mandate corrective action. This cycle operates like a continuous engine. We plan the targets, we direct the resources and spending, we control by measuring performance against the baseline, and we use that feedback to fuel the next planning cycle. It's a loop of constant improvement. Here is the master equation. A budget is a perfect, cold, logical mechanism until it is handed to human beings. The moment a budget is deployed to a workforce, it ceases to be a simple mathematical exercise and becomes a behavioral science tool. People are the unpredictable variable. How management sets these financial targets directly dictates the psychological response of the entire workforce. If the numbers don't feel right, the results won't either. Take a look at this curve. Loosely set goals are too easy to achieve and lead to complacency. Tightly set goals are unattainable and breed discouragement or even abandonment of the metric. The optimal challenge is that sweet spot where goals demand peak performance without triggering despair. Because managers want to look good, we often see budgetary slack. This is when managers intentionally build padding into their departmental budgets to make their goals easier to achieve. The motivation? Simple self-preservation to ensure a favorable evaluation later on. Managers pull 2 main financial levers to create this slack. They might overestimate expenses, requesting more capital than they actually need. Or they might underestimate revenue, projecting artificially low targets so that even average performance looks like an exceptional beat at year-end. How we build the budget matters. An imposed budget is top-down and rapid, but employees often view it as adversarial. A participative budget uses bottom-up departmental insight. It increases commitment, but, as we just discussed, carries a much higher risk of budgetary slack. The ultimate objective is goal congruence. A budget is only truly successful if it engineers a perfect overlap, where the individual, self-interested goals of managers align with the strategic objectives of the entire company. This is the true art of management accounting. You are never just balancing a spreadsheet. You are balancing the motivation, behavior, and alignment of the people executing the plan. Now we must define our horizon. A static fiscal year is a fixed 12-month projection. However, many modern firms use a continuous budget. This is a rolling 12-month projection that drops the past month and adds a future one, keeping the focus always on the year ahead. Who actually builds this? The budget committee, usually consisting of the CEO, CFO, and a budget director. Their role is to review and coordinate the information flowing upward from the department heads to finalize the ultimate blueprint. There are 2 main philosophies. Zero-based budgeting starts from scratch. Every single activity must be justified for the new period. Incremental budgeting is more traditional, using last year's budget as a starting point and only justifying the changes or additions. Technology makes this possible. ERP systems allow for automated, real-time data integration across all departments. And spreadsheet modeling allows us to perform what-if analysis, seeing how adjusting one variable, like sales price, impacts the bottom line instantly. The master budget is the big one. It is a comprehensive, integrated set of operating and financial budgets that serve as the ultimate financial plan for the entire company. Think of it as an ecosystem. It all starts with the sales budget. That triggers the production budget, which leads to materials, labor, and overhead. Eventually, this all flows into the cash budget and the final financial statements. The master budget rests on 2 pillars. Operating budgets focus on the income statement activities like production and labor. Financial budgets focus on your liquidity and overall asset position, including the cash flow budget and the balance sheet. The sales budget is the ignition switch. You cannot determine how much to produce what materials to buy, or how much cash you'll collect until you know exactly what you are going to sell. The operating budget is a chain reaction of planning and control. One step determines the next. Here is the anatomy. Sales leads to production. Production splits into materials, labor, and overhead. All of these converge into the budgeted income statement. The sequence cannot be broken. The engine is a simple formula. Budgeted sales volume multiplied by the selling price equals your total revenue. Every other manufacturing target depends on this number. For example, if we expect to sell 4,000 units in quarter 1 and 5,500 in quarter 2 at $25 each, our total revenue foundation for the first half is $237,500. Next, we have the production budget. This balances sales demand with inventory needs. It ensures we have enough to ship out without holding too much beginning inventory or running out of safety buffers. The logic is simple. Expected sales plus desired ending inventory minus estimated beginning inventory equals your total units to produce. In this example, to meet a sales goal of 4,000 units in quarter 1 while keeping a 1,100 unit safety buffer, we need 5,100 units. Subtract the 800 we already have. Our final manufacturing target is 4,300 units. Moving to quarter 2, our sales demand increased to 5,500 units. We also want to slightly increase our safety buffer to 1,200 units, bringing our total requirement to 6,700 units. Because the ending inventory of quarter 1 will automatically becomes the beginning inventory for quarter 2, we subtract those 1,100 units on hand. This results in a quarter 2 production target of 5,600 units. Now we translate that output to raw material costs. The direct materials purchases budget determines exactly what the factory floor needs to build those completed units. Step 1 is the baseline. Units to be produced multiplied by the material required per unit. This is the absolute minimum needed just to keep the assembly line running. Step 2 factors in the warehouse. Just like finished units, we balance what we need for production with what is already on the shelves to find our answer. The formula is total materials for production plus desired ending materials inventory minus estimated beginning materials inventory equals your total raw materials to purchase. Then we look at people. The direct labor budget estimates the total hours required and the associated financial cost. We calculate this by department, like machining and assembly, multiplying the required hours by the departmental hourly rate to find our total direct labor cost. Don't forget the overhead. This includes variable overhead that fluctuates with volume, like utilities, and fixed overhead that stays constant, like factory insurance. A detailed breakdown usually includes indirect labor, utilities, depreciation, and insurance. All of these combine into your total factory overhead. Everything converges at cost of goods sold. Materials, labor, and overhead are consolidated into this single metric, ready to be measured against your revenue. Beyond the factory, we have selling expenses to generate revenue and administrative expenses to run the corporate office. This budget covers all non-manufacturing overhead. The grand finale of the operating budget is the budgeted income statement. But remember, this prediction of net income is only as accurate as that very first sales target. The final math is revenue minus cost of goods sold equals gross profit. Subtract your selling and administrative expenses, and you have your budgeted operating income. Now let's move into financial budgets and the rigid reality of the static budget. Operating budgets plan for income, but financial budgets provide the ultimate test of organizational health. They answer, do we have the cash to survive the month? And are we building long-term value? The cash budget is the liquidity engine. It summarizes expected receipts and payments to prevent short-term insolvency and tells management exactly when they need to borrow money. Remember, cash doesn't always arrive when the sale is made. In this example, a portion of March sales and a portion of April sales combine to form your total April cash inflow. First, we look back at our performance from March. We recorded $100,000 in March sales. According to our collection patterns, 75% of our sales are typically collected in the following month. This means that in April, we expect to receive $75,000 from those March customers. Next, we look at April's own projected sales of $126,000. Our data shows we collect 25% of our sales in the same month they are made. 25% of $126,000 gives us $31,500 in immediate cash. By adding these two streams together, the $75,000 from March and the $31,500 from April, We arrive at our total April cash inflow of $106,500. This is the actual amount of usable cash hitting our accounts, which is the number we must use to plan our spending and borrowing needs. The cash then flows out through a pipeline to fund materials, labor, factory overhead, dividends, and non-manufacturing costs. By comparing your ending cash balance to your minimum cash requirement, you trigger a decision. Do we invest a surplus for yield, or do we activate financing to cover a deficiency? The monthly dashboard gives you the final answer. Beginning balance plus receipts, minus payments, plus or minus financing, gives you your final ending cash balance. In this example, we start with a beginning cash balance of $10,000. To this, we add our estimated cash receipts, which total $26,207. After accounting for our outflows, we subtract our estimated cash payments of $19,775. This brings the dashboard to a preliminary cash balance of $36,803. Finally, after factoring in our financing and borrowing needs of $1,000, we arrive at our final ending cash balance of $27,035. This final number represents the quote oxygen available to the company for the start of the next period. It tells management exactly how much breathing room they have before they need to tap into credit lines or reinvest surplus funds. While cash is short-term, the capital expenditures budget looks 5 to 10 years ahead. It plans for major assets, like machinery and buildings, that will drive all future revenue. The apex of the entire process is the budgeted balance sheet. It uses data from every previous budget to predict the company's exact financial position and net worth at the end of the period. Finally, we must address the static budget. This is prepared for only one specific, planned level of activity. It never changes, regardless of whether volume spikes or plummets. Let us analyze this performance scorecard to see how a static budget functions in practice. In this scenario, we originally planned for 5,000 units, but our actual volume reached 5,800 units. First, look at our sales revenue. We budgeted $50,000, but we actually brought in $56,000. This results in a $6,000 favorable variance. On the surface, this looks like a major win. However, move down to variable costs. We budgeted $30,000, but our actual spending was $34,000. This creates a $4,000 unfavorable variance. In a static budget environment, this manager might be penalized for overspending. Finally, we reach operating income. Our budgeted target was $20,000, and our actual result was $22,000, leaving us with a $2,000 favorable variance. Is this a fair way to judge a manager's performance? While the bottom line is favorable, the $4,000 cost overrun is entirely due to the fact that we produced 800 more units than planned. This is the fundamental trap of the static frame. It cannot adjust for changes in volume, often marking natural, necessary cost increases as a failure. This is the fundamental flaw of the static frame. Because it cannot adjust for volume, it often penalizes managers for natural cost increases that happen when sales exceed expectations. To truly evaluate performance, we need a system that flexes with reality. And that is the exact problem solved by flexible budgeting, which we will explore next.